Bob, it's great to see you again. And as we stand on the precipice of potential tariff trade wars, we now have the August 1st deadline. What's going through your head?
Well, I think in a world of significant policy uncertainty, the question is really about looking at what's priced in relative to what the range of plausible outcomes are. And what I mean priced in across the financial markets. And I think there is the case that kind of opens up one of the more interesting dynamics that we see in the markets today, which is if you look at something like the equity market, the current pricing of equities, now it's easy to forget, we're almost 10% above pre-Liberation Day levels. We're making new highs. All of that implies a totally sanguine environment. But when you look at the actual policies that have been announced, what you see is a combination of policies that are much more negative to growth than people expected. And even on tariffs, basically the same levels today as we saw post-Liberation Day. And so that creates an interesting divergence where essentially the markets are pricing in full-on reversal of all of these different policies such that they won't have a negative growth effect. Whereas, I'd say the range of possible outcomes are, that's certainly a possible outcome, but I think there are certainly many other outcomes in which these policies stay in place until there's sufficient pain to reverse them.
I want to break down a lot of what you just said, and I'm going to be very selfish. We are at the top. We're back where we were before Liberation Day. We're even a little bit better. So in my vernacular, I would say we're at the top. Maybe now is a good time for those of us who have been S&P stalwarts. Time to transition out. And you talked about this in another podcast recently, the outflows. People who've been very U.S.-centric might want to start looking at international funds. What would you do in this situation? I don't think you would ever be like some of us, all in one, perhaps, kind of asset class. But what should people be looking at right now, and should they definitely be looking outside the United States?
Well, I think the question is if you have the view that we're still going to sort of in a longer term perspective have a decent growth environment. The question is what do you pay for to buy that growth environment, right? As a simple example, if you look at non-US equities, you get the benefit of both a falling dollar as well as the significant monetary and fiscal stimulations that are happening globally, whether it's in Europe, the UK, China, and other emerging markets. That's all a very attractive set of opportunities given the low valuations. In fact, if we weren't talking about a trade war, we'd probably be talking about a global monetary and fiscal stimulation that was happening outside the U.S. And that's typically, when paired with low valuations, it's typically a very good time to buy those equities. So you could look there, or if you're still focused on the U.S. and you want to buy that growth story, there's other sectors of the market that are much more interesting. For instance, high yield spreads are quite compelling. They're kind of, I'd say, at sort of long-term fair value right now. If you do a bottoms-up analysis, which I won't bore everyone with, but and the reason is even though spreads have compressed somewhat, the credit quality of the issuers has improved considerably, and so you put that together. That's sort of a fair value way to buy growth. Whereas when you're looking at something like U.S. equities, we're at PEs and implied earnings growth expectations that are basically at all-time highs. So if you want to bet on the U.S. economy, I would be betting on credit much more than I would be betting on stocks here.
Not an exact quote, but I pulled something you put on X that I wanted to ask you about when you said tariff collection has taken some time to ramp up, which has delayed the impact on the end consumer. With normal supply chain timing, it's probably not until late summer until we can definitely see how much of the tariffs are being paid by consumer versus absorbed by business. And I made my own little cheat sheet note, and what I wrote was, you're not seeing a wage spiral up, and we're not seeing inflation. Are you saying in that Twitter post, in that X post, that get ready because it's coming, or are you saying something else?
Well, I think first I'd say we are engaged in a policy experiment unlike any policy experiment that has ever existed before. We are going from low tariffs to Smoot-Hawley level tariffs in the course of months, which is, arguably the largest tariff shift in modern economic history. on the largest economy in the world. So there's a lot of uncertainty about how this is going to play out, right? And so looking at any one, how did the tiny Chinese tariffs play out in 2018 or whatever is totally irrelevant because we're in a totally different policy environment, set of magnitudes here. And so when I say that, I think some people are rushing to declare that there is no inflationary effect from the tariffs. And I think it's important to recognize that you probably don't know. In fact, a sort of neutral economist looking at the data would say, we don't have enough information yet to conclude one way or the other. A big reason why that is because it actually took significant time to ramp up the tariffs. So if you look at, for instance, the announced policies in April, which were, as high as in the 20s in terms of effective tariff rate, versus the actual collections, which were only a couple percent above what they had been in the previous year, that's a huge divergence, and it highlighted the fact that it's taking time to ramp it up, and we shouldn't be surprised about that. I mean, if you ever ask the government to do anything, go to the local social security office and try and figure out, how fast moving they are, it's going to take them forever. There's literally paperwork that's got to get done. You got to train people, got to educate people. And so when we look at actually the tariff rise, it's not really until June where we're even getting close to the announced policy rate when it comes to effective collections. Now you take that and then you add in that it takes time to affect supply chains, meaning tariffs come on, goods come on shore, and it takes, 3 months or so to get it onto the shelf with a lot of variability. And now we're talking about, we basically we have no information about what the effect is on the end consumer because we haven't even seen the tariffs being meaningfully collected in a way that could affect those subsequent goods prices until basically today. So what I'd say is the jury's out. And we have to sort of accept this ambiguity. Yes, there is ambiguity about this. Now, everyone has a theory. A lot of those theories are politically motivated. It's in some ways it's kind of silly to go into those theories because, we're going to find out in something like 3 or 6 months how this is going to play out. But I think anyone who's out there saying tariffs don't cause inflation, they're not engaged in a data-driven analysis. They're engaged in a theory-driven analysis at this point.
So there was something you said that actually frightened me because I am closer to retirement age than are you, and I think you've probably done a lot better with your investments, although I'm not complaining about our position. The administration swings back to an aggressive pursuit of tariffs while markets remain sanguine about the future. The trouble, I believe you put on X, is without market pain, the taco trade won't come to fruition. What are you saying to us there? I know what made me afraid and what I think you're saying, but clarify.
Yeah, if you look back through time, just take this administration out of it and just look back through time. And if you've been trading markets long enough, you sort of lived through many cycles of this. The thing that causes policymakers to respond is pain, right? And so it's important to recognize that the path of response is first pain, then policy that alleviates that pain. And so taco, which is, the expectation that Trump is going to chicken out, is a theory that tariff policy or other growth negative policies are going to get reversed relatively quickly. And so therefore, who cares? You should just buy, you should just buy at today's levels. I think the trouble with that is that there's not necessarily an understanding or an appreciation of the sequencing, because the sequencing matters, meaning Trump didn't chicken out on Liberation Day, right? He chickened out after stocks went down 15 or 20%. That's when he chickened out. And to be clear, he didn't really chicken out all that much. Like the effective tariff rate right now is between 15 and 20%, depending on how you calculate it, down from between 20 and 25%. So it's not like there was much chickening out from a macroeconomic perspective, right? But the actual response to at least do something took a 20% decline in stocks. Okay, so if you think that Trump is going to chicken out on this most recent round of tariffs, what has to happen, what has to occur in order for that to happen is we have to have markets going down. The longer that markets stay up, the more likely the administration is to actually implement these policies and to keep them in place until there are significant macroeconomic effects. And I think one of the real challenges is at some point, the macroeconomic effects are not reversible. Meaning, if you have a negative growth shock from policy that then translates into shifts in private sector behavior, the policy reversal may not be enough to actually reverse things. We saw that in 2008 in terms of how that played out until there was a mega policy response. And so I think that's kind of the question, the idea of like, okay, well, if there's too much pain, they'll just reverse it. It neglects the possibility that if you get layoffs and things like that, it's going to cause a second and third order consequences.
And so I want to break down what you just said, and I'm going to do it from different vantage points, but Gen X, I'm talking to the Gen Xers out there, and then to the millennials, the generation right behind us. The rest of them have plenty of time to figure the world out after that. But what you just said takes my breath away, because for most of my adult life, it was very easy. Look, we had ups, we had expected downs. Jamie Dimon 10 years ago, or after the great financial crisis, said these things happen every 10 years. And whether he was right in the timing, the fact is, and then we always recover. It was always recover and then off to better. Does that cycle remain, or are you saying that we have the potential to change the foundations of, I'll call it the investing economy, to a degree that those cycles we all grew up with in Gen X and millennials have come to expect, that they are not going to be the same from this day forward?
Well, I think I probably wouldn't write off the likelihood that we're going to continue to have cycles and that there'll be ups and downs and things like that. From a strategic perspective, what that means is that the best thing that you can be doing is incrementally investing in financial assets over time, because they will most likely outperform cash over time, and your best bet is to be about as diversified as you can be when you're doing that, while achieving while putting yourself in a position to accept the risks that exist and not essentially shift to cash when there's too much pain. What I'd say is the question is really about the time frame, right? So, I remember when I was getting started in investing, a lot of folks looked at the period from, let's say, 1995, which then extended until the early 2010s, where there was effectively zero return on stocks. Now, and periods of multi-year drawdowns of stocks, 3-5 years drawdowns in stocks. And so the question is, can you absorb that? Can you accept a multi-year drawdown in stocks, given where your position is? If you can't accept a multi-year drawdown in stocks, which, to be clear, in the last 15 years, we have had a multi-week drawdown in stocks, basically, right? That's kind of like the order of magnitude. But that is abnormal, not normal. If you look through time, typically you have extended periods of, particularly on real return basis, 10, 12 years of negative, of drawdowns in real returns in U.S. stocks. And so I think the issue is, as you get closer to retirement, that becomes less and less palatable. If you're 22, who cares? You got your whole life ahead of you. You earn plenty of income. You can invest in the lower, you can invest at lower prices. It's actually, on the margin, actually probably good for you over a longer term savings period. But if you're 60 and retiring, you can't absorb a 10-year drawdown in stocks. It'll eat you alive. And so that's really the question there, is where you are in that timing. Because where you are in that timing influences whether or not you can absorb that volatility.
Does the outflow of investable dollars from the United States overseas, is that the obvious thing? It's what you just said. I mean, people are repositioning, or is there something else that you see behind that?
If anything, what was unusual with that was that people, foreigners, particularly in Europe and Japan, were massively overweight U.S. financial assets for the course of the last 15 years. And, there's some sort of structural reasons why that would be. The U.S. came out of the global financial crisis better, had higher interest rates, had stronger growth, had more innovation, et cetera. But that sort of cycle, at some point becomes extreme and relies on extremely high levels of capital in order to continue. So as an example, there was one point where the U.S. was getting about 70% of every incremental dollar flowing into global financial markets. Like, does that make any sense? Like, not really, from a longer term perspective. And so, particularly when the U.S. only has about 20% of the world's GDP, if you just think about it. And so that's the sort of thing. Those sort of cyclical dynamics are, maybe they're kind of halfway between cyclical and secular dynamics. They shift around over time, and we went from a period where the U.S. was, essentially the cheapest financial assets and the most eschewed right after the financial crisis, to the one where everyone in the world was overweight it, and now that's starting to shift back. That's the sort of thing that could play out over 5 or 10 years, and in the process lead to underperformance of U.S. assets by 50, 75% relative to the rest of the world, just in the same way U.S. assets outperformed the rest of the world by a similar amount over the past 15 years.
Yeah, I think you just touched upon something that I want to tease for. I want people to know we're going to talk about the decline of the dollar and the doom loop. And I think you just hinted a bit at that. But before we get there, I want to back up a second. You seem remarkably calm and optimistic about where we are at this moment in financial history. Am I reading that correctly?
Oh, yeah. I mean, I saw a poll on Twitter, just as a simple example, that said, what was worse, the global financial crisis or today? And something like 50% of people said that that today was worse than the global financial crisis. And I looked at that and I said, you got to be kidding me. Like, in 2008, we stared into the abyss. There was a real question about whether every financial institution in the world, I mean, there wasn't a question. Every financial institution in the world was broke. Just keep that in your mind. Every insurance company, every bank, every broker, every single one was bankrupt. And, there was a policy response to it. It was obviously an incredibly painful experience, so I don't want to make light of it, but we were able to navigate our way out. Today, like, it's not even close. And the lessons that we learned at that period helped cut off essentially a left tail scenario for generations to come. So the cone of possibilities that we're talking about here is much narrower than what we saw in back in the global financial crisis. It doesn't mean that real returns on financial assets are going to be good. Real returns on bonds are going to be good. The dollar is going to be strong. It doesn't mean any of those things. But the idea that we're going to have some total meltdown of the financial system, I've seen it. I stood very close to everything that was going on. We got through it, and so like the crazy doomers that say the world is coming to an end, like I got no time for that, and that's functionally not that useful.
Hearing that from someone who's younger is greatly appreciated. I remember I was there and I was covering the White House and Capitol Hill and the Fed when they took the first TARP vote way back during the financial crisis, and it failed. And I remember getting on the train to come back to New York that evening, and very melodramatic, forgive me, wrist to forehead, the world's coming to an end. Scene out of Ayn Rand's Atlas Shrugged, and I have friends who say that's the best comedy ever written. I don't want to go there. But when the steam engine goes into the mountain and everyone dies because of asphyxiation, I remember sitting on that train thinking the people outside these windows as it was going past different places in Delaware and New Jersey have no clue what's about to hit them. And thank God it didn't hit as bad as it could have. But I realize that today is not yesterday and you can't change the past. But then I'm looking at what's going on politically from the standpoint of living through 4 different big drops in my lifetime. And I'm looking at what's happening politically, and I'm wondering if younger people, and I'm saying even younger than millennials, appreciate the financial tools that make the standard of living that we have today possible. What I'm alluding to is what's about to happen in New York City with the election of a certain candidate. You can share your politics if you want, you don't have to. But it frightens me that people discount the fact that, I heard the statistic, 80% of people over the last 40 years have risen out of abstract poverty worldwide because of capitalism, but also because of what you and I are talking about, the ability to invest, the ability to lose, but then the ability to come back and start over. And I feel like we're about to throw that out the window.
Well, I think the question is do you continue to have? Do you have an economic structure that continues to incentivize innovation and raising and productivity and raising incomes? Because ultimately, like, there's lots of cyclical dynamics that are going on, but the thing that drives incomes over a multi-decade time frame and the things that drives standard of living is productivity. So then the question becomes, are we in an environment where whether it's a state and local system or whether the federal government system is such that that there is sufficiently disruptive policy to create a negative innovation environment? And that's something that it doesn't seem that way. It also is a question that negative innovation environment is really dependent upon whether capital is being punitively harmed for investing, to invest in order to create increasingly productive activities. And so, if anything, like, capital has been over-incentivized over the course of the last 15 years or something like that. Meaning, it's been it's been great for capital, and worse for labor. And so, that shifting back, like as a simple example, current the
swing, it's back to the center, perhaps.
Yeah, current margins are at the highest level that they've been ever for companies. Okay, well, could they fall 50% and go back to 1995 levels? Like, yeah, why not? That wouldn't totally just. 1995 was a great time for innovation, right? There was lots of incentives to do it, even though margins were effectively lower at that time. So I don't. And maybe this is sort of like from a macroeconomist perspective, having studied a lot of different cycles and countries and things like that. Like, the macroeconomy is more powerful than any political figure.
Say that again. So, I think what you just said is paramount important. Can you repeat that, please?
Yeah, I'd say the macroeconomy is just more powerful than any political figure. And so, I sort of joke, like, New York, like, how many horrific mayors have there been of New York over the course of the last, 5 decades?
I only have 10 fingers. I can't count.
Yeah, exactly, right? I mean, I'm not going to, this isn't a political point, meaning like a partisan point. It's just like, how many terrible mayors have there been? And nonetheless, like, New York is the financial capital of the world and more innovative than any other place in the world, and, wildly successful. And, people will live in shoeboxes to live there because it's such a wonderful place. That's because the economy of New York is far more important, far more compelling than is, any political institution. And so most of this stuff that we talk about, it's really at the margin relative to the power of the underlying momentum of the U.S. economy.
Before we get to the doom loop, I just want to follow up on what you said, though, because I think that's the foundation. When I talk about people in Gen X or millennials, what I think we came to appreciate about investing or being an entrepreneur is, in the United States, you can fail and you can start again. Henry Ford failed how many times? The first Ford Motor Company went bankrupt. It was disaster. But you can start again. And the question with investing, you can lose a lot of money, but the next day you can make a lot of money. You can, depending on your time horizons. What I heard you just say, though, is all of us in New York City who might be, as the kids say, clutching the pearls, freaking out. Stop freaking out. It's New York City. And we've had how many bad mayors?
Right. I mean, not to mention the fact that a mayor actually is like not that powerful in New York, and the mayor doesn't just like write down a number for the tax rate. It's just like not how it works. And part of that is there are both sort of strategic checks and balances. There's also like tactical decision making checks and balances that exist everywhere throughout the policy making environment. Like, just take the big beautiful bill. Like, there's, I think, partisans will talk in extremity about how wonderful it is or how terrible it is. From a macroeconomic perspective, kind of a snoozer. Like, you're expanding the deficit. You're basically extending current law on taxes and you're expanding the deficit by 50 basis points. Like, honestly, who cares? Like, it's kind of nothing,
Well,
right? I'm not saying there's obviously lots of there's winners and there's losers and there's all sorts of underlying things going on under the hood related to it. But I'm just saying, like, all of that noise that goes on, and we were talking about 50 basis points of deficit expansion, like, who cares?
I think
Like, from a macroeconomic perspective.
when you talk about the noise and the background noise that all of us have in our heads, the ancient philosopher Seneca, fear, the imagination in our head is far worse than the reality. But let me ask you, because you just said, who really cares? Ray Dalio cares. If I heard him correctly, he was on, and you certainly have a relationship with Mr. Dalio. I think 10 years as his right-hand man. He was on CNBC. And what I heard him say, which made my, panicky ears perk up, he said, look, we have about 3 years to fix all of this. And after that, there could be some kind of debt event that really creates a crisis that there's, no one in the United States has ever lived through what people in Argentina have been through or what people in Greece went through during a debt initiated crisis. But he was alluding to that coming our way within 3 years if we don't get it right. Did you catch this conversation with him on that TV network?
I mean, I didn't catch that specific conversation, but that rhetoric is not much different than what I've heard for decades. And to be clear, has not translated into reality. And I think it's one of the challenges that kind of the old guard macro folks have when they look at the world today. They look at the world through a credit lens. So, as an example, Greece and Argentina are nothing like the United States circumstance. And the reason why that is because both Greece and Argentina had significant debts in foreign currencies that they could not print. And so as a result, they were essentially faced with a credit event, which you basically have two choices. You default or you tighten your belts, and that and in reality, you end up doing a little bit of both, and that ends up creating terrible economic conditions. The current situation in the United States is not that. The United States has unlimited ability to print money. It has the debts are in its own currency. It has unlimited ability to print money. It's much more akin to a Japanese scenario. Now, remember, if we just take a step back and we look at how Japan looks today, Japan has the highest government debt of any major developed country by a mile. And yet, it has the lowest term structure of interest rates for the vast majority of its term structure of any major economy in the world, and has had that for decades. And so, what kind of debt problem are we talking about? Like, the return on Japanese bonds has been fine relative to cash over the course of the last 20 or 30 years. Now, a lot of people are going to throw up a chart of like 30-year Japanese government bonds. We could talk about that. No one really trades 30-year Japanese government bonds. It's not really a liquid market. For any of the market that really matters, essentially, the return on bonds has been fine. So this idea that there's going to be a debt event is, it is not well supported by the underlying macroeconomic dynamics or the empirical evidence of countries that have faced a similar circumstance.
When I first started at Fox Business, 20 years ago, I used to write these stories and produce these stories all the time. And then I remember about 10 years into it thinking, but it hasn't happened yet. It hasn't happened yet. But what I hear the Ray Dalios of the world saying, but it will. But actually, no, they're not saying it will. They're saying, but it could. I guess the response to that is something the team I used to work with at Yahoo, I used to say, well, yeah, my uncle could get a sex change and become my aunt. Could happen, but doubt it. You're saying doubt it. You're not really as concerned as Mr. Dalio might be.
Well, I'm just saying that the case that's being made is not based upon how the macroeconomy works, right? It's a bad understanding of how the U.S. position relative to other corollaries that are being referenced. And so what I'd say about that is, whatever, it makes for nice rhetoric, makes for nice headlines, gets you on TV, but it's not particularly useful in trading financial markets over a short time, over a time frame that basically anyone cares about. So you take those two things together, it's neither based in a good understanding of macroeconomic realities, nor particularly useful in trading markets. And you put that together, and it's basically noise. You shouldn't listen to it. Anyone who's talking about that, it's a waste of time.
I waste a lot of time sometimes with CNBC.
It's a waste of time. What I'd say is that what is probably more relevant when you look at the story with Japan is that when you have very high debt levels, and the U.S. debt levels are not nearly as high as Japan's, and the U.S. is a lot more productive and has better population growth. But when you look at that sort of circumstance, there is an inevitable circumstance that has to play out, which is that more likely than not, the returns of those bonds in hard currency or in real terms are likely to be not particularly good. That's a circumstance that we've seen, as a simple example, for many instances over the course of the last few hundred years across many economies. Meaning, a good example is coming out of the Second World War. Lots of developed economies were laden with very high debt burdens because they spent a lot during the war, the UK, the US, etc. And what you saw is a period of time in the 50s and the 60s where the returns of bonds were mediocre. Now, as far as I can tell, nobody, particularly in real terms, they were mediocre. And what that allowed you to do was basically raise nominal incomes relative to the existing debts and defease the existing debt stock. The same is kind of true in Japan, where the returns in hard currency terms, let's say the returns of Japanese bonds in gold terms, hasn't been particularly good over the last 20 or 30 years. But in neither of those cases is anyone running around making a case that those were debt crises. Those were instead, long-term bad returns in bonds that in real terms that disadvantage bondholders relative to holders of physical assets or hard money. And that was okay. That was not, there was no great disruption that occurred. I mean, the US in the 50s and the 60s was probably arguably the golden age of the United States. Japan actually finally getting their debt, finally actually starting to devalue their currency relative to hard assets has actually improved the conditions in Japan over the course of the last 10 years or so. And so these things are totally manageable. What you have to understand is, though, that they do have implications for long-term returns of financial assets. And so if we turn back to what the everyday investor is looking at, the everyday investor basically holds two assets, which is stocks and bonds. And we're facing a circumstance where bonds in particular, which have had a very good real return over the course of the last 40 years, are set up to not have a particularly good return over the next 20 or 30 years, just in the same way they had a pretty bad return in the 50s, 60s, and 70s. And so in that circumstance, it's important to buttress your portfolio with those assets that do well in those environments, so things like gold and other hard money assets that will do better in that environment, or at least diversify out of bonds, at least to some extent, because you're overweight bonds having a good real return ahead.
You just told me for free what I'm paying a commission to the guy who's going to do that for me from the discussion I had yesterday about our future. Enough about me. Let's get back to the doom loop, because this was something else that you brought up. And before we started talking about this, it's the decline of the dollar and the threats that poses. I think there's a quote in here. Your bonds are bought by European investors. Your stock is bought by European investors. That is making you feel wealthier. I think a lot of us felt very wealthy for the last 20 years. But is that now changing? And explain for us the doom loop. What worries you or doesn't worry you about it?
Well, I'm not sure I would necessarily call this a doom loop. I'd call this, a sensible retrenchment of foreign investors on U.S. assets, in the sense of they, have been way overweight in terms of their buying of U.S. assets over the course of the last 15 years, and simply not buying at that level, and instead scaling back their buying towards something that is, even modestly overweight incremental buying of U.S. assets, not just extremely overweight, has to be replaced by U.S. investors in order to keep prices at current levels. And so, I think that's the basic challenge. It also will deteriorate the returns of U.S. assets in foreign currency terms, and that in itself it's a bit self-reinforcing in the sense of if you're a European-based investor, you start to scale back your demand for U.S. assets. Those assets both fall in dollar terms, but they also fall in your own currency terms as you repatriate capital or slow the amount of capital that you're sending out, which then makes those assets look like they have a worse return in your currency terms, and then it starts to create a circumstance where you're getting a compounded effect of weaker asset returns and weaker currency returns, which leads to incentive to continue to pull back. Those are the sorts of things they play out. That's kind of the reverse of what we saw in the previous 15 years, and so those things take time, and particularly because the investors that we're talking about are European institutional investors, which, if you think U.S. institutional investors are slow moving, man, European institutional investors are slow moving. And so these are the sorts of things that, it's going to take years for the investment committee to change its allocation. It's going to take years for those flows to actually occur. This is a very, very long-term, secular dynamic that's probably going to disadvantage U.S. assets relative to foreign assets for, a decade or two.
Well, when we talk about asset pricing, what indicators, what market signals should we be looking at if we're at a kind of peak right now for U.S., for instance, equities? I mean, just the other day, NVIDIA, for instance, 4 trillion market cap. What indicators do you look at to say, enough, or I'm piling in?
Well, I think on the global allocation trade, I think about it like from the perspective there's levels, meaning like the U.S. equity market cap as a share of global market cap got up to 70%, depending on exactly which way you're looking at it, and then you look at that and you say, okay, that's pretty high, and then the question is there catalyst is kind of it's an overused term, but basically, are there pressures for it to move in the opposite direction? And we've seen that over the course of the last 6 months with the currency falling, significantly, as well as sort of more macroeconomic fundamentals where we're seeing a slowing economy while the prices in dollars are going up, are at highs. We are seeing indications of slowing macroeconomic environment. Those are the sorts of things I look at those combinations and I say, that's not a great, a very high level with that sort of turning point and pressures that exist are not the sort of things that are particularly compelling in terms of holding those assets. And when I look abroad, what I see is relatively significant monetary and fiscal stimulation that's being brought to bear in an environment where, their share of global capital is basically at multi-decade lows. And you're seeing, the economic circumstances in some of those economies look better on a forward-looking basis than they have been in the last few years. And so you sort of put that together, that's the sort of thing that could start to shift those two, that could start to drive that reallocation between U.S. and foreign investors.
May I ask, how do you position your portfolio right now?
Well, I think from a long-term strategic perspective, probably what I'd emphasize is that most investors don't have enough contra currency or hard assets in their portfolio. Like if you go scan, RIAs, how many RIAs hold any gold? It's like 5%, and on average they hold 1% of the total portfolios. Whereas, at a minimum, everyone holds bonds. Okay, so if you believe in this sort of story that there's going to be a more strategic, longer term for real return on bonds and a better return on hard assets, you should at least match your risk between bonds and gold, which would mean about, let's say out of your 40% in bonds, maybe you put 10% in gold, right? So you have a 10% allocation to gold. So that's an important strategic element. The other thing I'd say in this sort of environment that's really important is that whereas it was very easy to just buy assets, and if anything, buying the riskier asset, the better, over the course of the last 15 years, we've reached a point where it's less likely that it'll be as easy as that in the future, given the current level of asset prices and what's implied. And so that starts to create an opportunity to add more tactical strategies into a portfolio, particularly ones that can go both long and short, which can help defend a portfolio in the event that we have an extended period of weaker asset returns. And so whether that's, there's lots of stuff that's out there. You could go look at things like managed futures, ETFs, global macro ETFs, things that have that flexibility to be both long and short, if the set of conditions, continues to shift in a way that is detrimental to financial assets ahead.
I'm going to get to the specific questions that some colleagues wanted me to ask you, but I just want to take a quick, ask you a personal question. I would not have the stomach or the fortitude to deal with what you've just described on a daily basis. My stomach couldn't handle it. Why do you do this? What do you get out of it? I know it's got to be more than just the reward of success, or is it?
In terms of being interested in the macroeconomy and markets, I think I often draw back to my sort of my background, which is really in the sciences, and as a botanist by academic training, and in a lot of ways I see the macroeconomy and markets as basically a fascinating system of how the world works, right? All of us interacting with each other through the lens of the macroeconomy, how the world works. Markets are just a great sort of scoreboard of what's actually happening, right? So real-time indications of what's actually happening. And so I find that interesting. And as an actor within that, right? If essentially we come to better understand ourselves by understanding the overall macroeconomic environment. And so that's, I think, underlying it. And one of the absolutely great things about trading markets and trying to understand the macroeconomy is that it could be a forever passion. Like, you talk to a surgeon who's done the same surgery for like 25 years. It's like, what does tomorrow look like? Well, I'm going to do the same surgery again. And I don't make light of what doctors are doing or whatever. That's very important stuff. But like, there is a monotony, right, to that. There's what feels like limits to how much you can advance in terms of your understanding. The beautiful thing about the macroeconomy and markets is we understand such a small share of how it all works that there is infinite learning. There's also infinite pain because you're going to be wrong a lot, but there's infinite learning. And so, I think when you look at people, let's say people who, have no financial reason to be engaged in markets, I think it's interesting because they continue to be interested about it. They continue to engage in the markets because it scratches that itch of constantly trying to learn, evolve, better understand, and be challenged.
I hear a lot of humility actually in your answer, and I'm curious, can you share with us, before I get to those, back to those financial questions, what have you learned about yourself, just say in the last, let's go right before the COVID pandemic. What have you learned as you do this about yourself?
Well, I think, it's a constant lesson of making sure that you're not overconfident in how you think things are likely to play out. And so, I think all of us sort of, it can be easy to wake up and be like, I know exactly how it's all going to work. I am certain it's going to be, the economy is going to work this way, or it's going to work that way, or markets are going to go in one way or another. And, I think in some ways this is sort of a constant whenever for people who have been around markets long enough, the real people who have really traded, have really had money on the line, who've really been taken on risk, let's say, they will, you can tell them by how they talk about markets, often mostly talking about all the things that they got wrong. And forgetting a lot of things that they got right, because that's part of the learning process. And so I think, I continue to find humility and recognition that there's a lot we don't understand, a lot we don't know, despite, the fact that I've been doing this for more than 2 decades.
All right. So here's the specific question from a colleague of mine who wanted me to ask you that you argue that achieving returns above risk premium now requires even more financial stimulus. What would be the most realistic or politically feasible policy lever to watch for in the near term?
Yeah, well, I think the question is in terms of additional stimulus. If you just look, like we've how do I say this? We've had some amount of fiscal stimulus, although we've had a number of negative growth policies related to that. So it's possible that we get some of those negative growth policies rolled back. So things like, more flexibility on immigration, and less tariffs. And so that, by rolling back what would otherwise be a drag, it is effectively a support. The Fed is relatively constrained here and probably only would cut more aggressively in a circumstance where there was meaningful economic pain. So I doubt the Fed is going to be all that proactive in terms of delivering monetary stimulation, certainly for the next year. Whether a new chair is able to convince all the other governors and board members to dump money in the streets, that remains to be seen. The markets certainly don't believe that. But, in the near term, I doubt we're going to get that, big easing from the Fed. It's also not that effective at this point. And so I think probably the biggest room for a meaningful easing is really around the regulatory front. And whether, banks and other financial intermediaries can be incentivized to lever up more significantly. And it's interesting, like if you look at banks, never have they been better capitalized, never have they been, earning better profits and things like that. And at the same time, they basically are doing nothing. Balance sheet expansion is de minimis. They're most of that balance sheet expansion is basically nothing into the real economy, and a limited amount, doing some financial leveraging that is pretty low risk. And so the question is, do any of those financial intermediaries basically lever up, incentivized by deregulation activities and an easing of those burdens? If you were to roll us back, I'm not saying that necessarily will happen, but you could roll us back 15 years on banking regulation, and that could create trillions of dollars of incremental stimulation into the economy. Hasn't been done yet, but could be done, and that's probably the most likely path in the course of the over time frame that anyone cares about.
I overheard a discussion on the subway the other day, and being a reporter, I'm nosy, and I didn't butt in, but I do eavesdrop. I'm not a professional reporter anymore. I'm in AI, and I got to get to AI with you. But they were two, I guess, what people would call finance bros, and one had asked the other, so what happens if China dumps its $1 trillion in U.S. bonds and holdings? And the other one said, never going to happen. They'd be shooting themselves in the foot. And it got my wheels turning because I was thinking about what would happen? Maybe they stop buying our debt. How would you have responded to those two if they were in, the classroom of Professor Elliott?
Well, the first thing I'd say is that for many years, the Chinese central bank has been a non-economic entity, meaning like they're not trying to maximize returns. If they were trying to maximize returns, they wouldn't be up to their eyeballs in treasuries, and by definition, almost like a central bank that is intervening in their currency markets to depress their currency is a negative expected value entity, because all the pressures are for the currency to rise, and they're essentially taking the opposite side of that trade. So I think a lot of people look at the Chinese and they're like, oh, if they sell their bonds, then they'll take a mark-to-market hit. The Chinese don't care at all about whether they take a mark-to-market hit on their reserve assets. I think the broader question is, does such a set of activities is that consistent with their geopolitical
It would cause
goals?
currency to go up in value, which would be shooting themselves in the foot. The one guy got it.
Well, not necessarily. Like they could hold treasury bills, they could hold U.S. dollar deposits, they could reduce their duration, which would be positions, which would be meaningfully influential on U.S. financial markets by causing a bond sell-off, without necessarily even having any effect on their currency. They could translate it to euros, they could buy yen. There's lots of different things that they could do without taking any pressure on their currency, and they know that, and they've been doing that to some extent in terms of diversifying their reserves. And so I think the real question is basically like, does it make any sense for them from an economic and geopolitical standpoint to introduce that set of uncertainty? You could imagine a circumstance where there is a kinetic war between the U.S. and China, either directly or indirectly. I'm not predicting that. I'm just saying that's a scenario that could play out where the Chinese could use their financial power to possibly inflict economic pain on the United States. The United States could go back in the other direction, of course, and just take all their treasuries, or at least the treasuries that are being custodied in Western institutions. And so, I look at all that and I say, like, is the Chinese selling their bonds likely to be a big part of what's going to happen in the world in the next few years? Like, probably not. And if we were in a circumstance where it would be a big influence, we'd know it. And it wouldn't be the most important thing we'd be talking about.
Probably be something that has to do with I'm going to say a country. The Chinese would say it's not a country that starts with a T.
Right. Exactly.
So as we start to wind down, I will get emails from people saying that was the stupidest question you ever asked, and it has to do with black swan events because you can't know it, right? What's the black swan event that you worry about coming our way?
Well, I think the biggest concern that I've got, and maybe it's black swan or not, who knows, is a self-reinforcing dynamic where negative growth policies create such a pressure on the U.S. economy that it then starts to translate into the private sector starting to withdraw, and that then sort of kind of gets ahead of what the policymaker response can be, which, to be clear, I guess at some level it's not really a black swan event. Like, that's typically how downturns work, right? That's how the end of economic expansions work, which is that the private sector starts to withdraw, expectations are high, the private sector withdraws, and that moves more quickly than the public sector, either the federal government or the Fed, can move to support the economy until you get to a point where the stimulation is enough to create a turn. So that is a pretty normal dynamic. I feel like describing a typical late cycle dynamic is almost sounds novel to people, given that we've basically not experienced one of these since the late 80s. And so in that sense, it's kind of like a black swan. It's like no one's ever seen traditional cyclical downturn, but we may be facing that given the magnitude of the negative growth policies that are being pursued by the current administration.
Yeah, but negative growth policies, but also I've been racking my brain to figure out the sourcing for this, but there are different theories about the fall of the Roman Empire. I'm not saying we're the new Roman Empire, but the devaluing of the currency was the drachma, whatever they used in ancient Rome, the removing of silver from the currency actually devalued the currency, which then precipitated, although things didn't move as quickly as they do now, the decline of that empire and the eventual collapse. Do you see parallels, with what's happening with the decline of the dollar, or am I really shooting in the dark with this one?
Well, I think the question is over what time frame do these things happen? And while, to be clear, like, if you take a step back, like, all fiat currencies have declined relative to hard money over the course of the last 5 years in particular, and I think that's a recognition that developed currencies and developed governments, they basically have too much debt and are going to have a bad return bad real return of their bonds, or essentially forward fiat money ahead. And so, what is the effect of that? Like, it's kind of an interesting story, because if you were sitting as a U.S. based investor spending U.S. dollars, you mostly feel that effect through inflation. of goods, and you don't really feel the effect of gold prices doubling or something like that, or Bitcoin being up significantly. But that's how it exposes itself, right? Which is that hard assets become more valuable relative to soft money assets, and so I think that's kind of the story. It's more an insidious story that that erosion takes time. I think people. I'm not a history buff or anything like that, but the Roman Empire took hundreds of years for it to,
and a lot more, and just the decline of the currency.
And people are talking on Twitter like it's going to take a few weeks.
Right.
So this may the time frames, our attention spans may be mismatched with the reality of how long these sorts of periods of decay really take.
The emails I'm going to get are also going to say Adam the drachma was the ancient Greek.
There you go.
So yeah. And apologies to the ancient Greeks who might be watching from Mount Olympus. Put your scientist hat on for me. I work in AI. The people, the computers you see behind me, there are humans. It's kind of a hybrid AI and human element. I'm blown away by what AI can do. When my friends say, we'll never do this, we'll never do that, I'm like, it's already doing that. What do you mean? My brother recently used AI to create a legal document, had a lawyer review it, but saved himself several $100s in having done it through AI as opposed to hiring the lawyer who would have a paralegal write it. I bring that up because does the discussion about AI replacing human beings and the undermining of the workforce throw a wrench into the things we've been talking about as far as potential growth going forward?
I'd say there's a lot of uncertainty about exactly how it's going to play out. It's important when you're thinking about productivity enhancements to think about two elements, which is one, how much of the technology advancement is going to be consumed via consumer surplus versus how much of it is going to be paid for, essentially, in the sense of we could get the ability, for instance, to talk with ChatGPT about, I don't know, philosophy or something like that might bring me a great deal of consumer surplus, happiness, satisfaction, things like that. But it might have literally zero effect on GDP, right?
Well,
zero.
When Satya Nadella talks about, we talked about this when you were on the other podcast several months ago, when 30% of the coders or 30% of the code at Microsoft is being written by AI. That means people, and we've seen layoffs at Microsoft. Those are people who are no longer working. If AI is replacing them, how are they getting dollars to then invest in a 401k or to spend into this economy? That's what I'm talking about, is the undermining of the human workforce. How do you replace their dollar value to propel the economy forward? We'll get productivity, but if people don't have $1 to go buy the Snicker bar, which is actually $2, what happens?
Well, I think there's sort of two questions, which is the technology productivity enhancing when you look back, for instance, does it enhance current labor? If you look back through time, I think it's kind of funny, we need to bring manufacturing back to America, and there's some national security elements of that which make a lot of sense, but to me it sounds like we need to get everyone back on the farm. Don't you realize that farming employment has gone down over the course of the last 150 years as a share of the U.S. economy? It was 75, 80%. Now it's 3%. Should everybody back to the farm? I kind of have that. And if I say that, people are like, what are you talking about? And I'm like, it's the same thing. Arguing that everyone should go back to the farm is the same thing as arguing we should have manufacturing, which is the same thing that's arguing that we should be, hesitant about AI, becoming, an innovation in our economy. It doesn't mean that there aren't winners and losers. It just means that when you think about the economy as a whole, what you're optimizing for is the highest productivity that you can get. If you can get the highest productivity growth, that will lead to the highest standard of living growth of the overall economy. And by and large, across most aspects of the economy, will lead to higher standards of living for pretty much everyone. And so what I'd say about that is, yes, of course, there's going to be winners and losers. The paralegal will be a loser. The person who wrote the AI, who's who's getting $300 million a year from Zuckerberg is going to be the winner. And so that's normal with any technological innovation. But in general, you don't want, in general, technological innovation is good, not bad, when thinking about the long-term productivity of the economy. The thing that is going to be challenging, and this is why I connected to the consumer surplus point, is what we're not going to have is we're not going to be able to have an environment where companies have radical surges of their margins, the way sort of the techno optimists will argue, without somebody paying for that spending. And if you lay off people and they don't have the money to spend, then you aren't necessarily going to get the margin expansion that many people are expecting. And so that's more of a subtle point.
There was a quick glitch in the Wi-Fi. If you don't say that again.
I'm saying, like, when you think about many of the techno-optimists believe that there's going to be a wild margin expansion for companies as a result of things like AI. And what I'd say is margin, which means how much you're paying, which is a function of how much you're paying labor, right, and labor is the one that spends, ultimately, like households essentially have to spend money on goods and services. And so what ends up happening is you can't have infinite margin expansion, because if you lay off a bunch of workers and they don't have money to spend, then how are you going to get the top line revenue to support the companies that are getting, they're supposedly getting all that margin? And so that's the so I'd separate the 2 points, which is we probably will have productivity enhancement that will raise GDP growth as a function of this. The amount in question, lots of different takes on that, but there will probably be some productivity enhancement that will support GDP. There will probably not be radical margin expansion, because to the extent that labor is cut and their income is cut, that's going to actually affect top line revenue of companies in aggregate, which means that it will be a bit self-defeating unless, some sector of the economy radically saves, which, with the US government at the levels of deficit that it has right now, is certainly not in a position to save. And so you put that all together, we're probably going to have higher GDP growth. We're probably not going to have a radical margin expansion. And we're probably going to have, some winners and some losers. And the losers, in their current roles, will, as all technological innovations have done through time, create a redistribution of labor in the economy to other things that have not been replaced by AI.
Okay. Last question. If this were the game show, tariff, no tariff, August 1st, does the president extend the tariff deadline, or do we stick to it? He said he's going to stick to it, but he says a lot of things that he doesn't stick to.
Well, I kind of like looking at this. I don't know if this is cheating out on your question, but I like looking at what the market expectations are. And I ran a survey on Twitter over the weekend about what people expect the average tariff rate to be over the course of the next through the end of the year. And basically, it's at the effective tariff rate. The effective tariff rate today is about 15 to 17%, depending on how you calculate it. And basically, people expect roughly that to exist through the end of the year. I don't have a particularly strong opinion above or below that. There's obviously trying to read the mind of the current president. Is I think a bit of a fool's errand. I'm not sure the current president can read the mind of the future. Of his mind in the future. So that consensus seems reasonable in terms of what I'd expect to have happen ahead. And what I'd say, kind of tying back to the beginning of this conversation, is if that consensus is the reality over the course of the next 6 months, that has macroeconomic consequences that are not at all priced in the financial markets today.